Karen? Huh? Good morning, all. Welcome to NDB's quarterly webinar that is dedicated to the investors to share the financials. And this time, we released our financial results to the Colombo Stock Exchange yesterday. And as we have been doing this for the last 5-6 years, having this investor webinar as part of our investor relationship management activities, this is the quarterly earnings call for the benefit of all the investors. So with me joining today, we have all the key business heads. Sanjay, who is the Senior Vice President, Personal Banking, Chief Operating Officer Deepal, Suendrini, who is the Head of Finance, Niran, Vice President Treasury, Indika, Vice President SME and Business Banking, Ishani, Vice President Project Finance, Vinod, who is the Vice President Corporate Banking and Wholesale Banking, Zian, who is the Vice President Branch Network, Damita, who is the Assistant Vice President Digital Banking, and Shankar, Assistant Vice President Corporate Planning. They are with me and they'll be there in case there are questions raised or later on to present. So I move on to the agenda. Basically, this is the agenda. And of course, after the presentation, there'll be time for question and answers. So I will take you through the corporate profile. I think most of you are quite familiar with NDB's profile, so will quickly go through this. Of course, now 41 years as a corporate bank, commercial bank. We originally started as a development bank with 113 branches, about 3,000 staff. And we have several group subsidiaries. I think we are the only commercial bank with subsidiaries in several investment banking and finance related activities like the NDB Investment Bank, NDB Wealth Management, the stockbroking arm, and also NDB Sefer, the Sefer Fund, and also our operations in Bangladesh. Of course, the 2020 was recognized quite well by international accolades that we have won. So I think we are one of the most awarded bank, and some of those have been highlighted, like the best bank by the Banker magazine UK, and also best digital bank by the Global Finance World Best Digital Banking Awards. Then the Asia Money has also rated us as the country's best bank award. Global Banking and Finance, again, best financial services group. And also locally, we were awarded as one of the 10 most respected entities by the CIMA and the ICCL. And also in the Business Today magazine, we have been ranked within the top 10. And also the Finance Derivatives Netherlands, they have also rated us as best domestic bank. So these are some of these awards that we have won. And I think these are some shareholder milestones that we have been sharing with our investors. I think those who are joined new, 1979 the bank was established, and since then in 2005 NDB acquired the commercial banking operations of ABN AMRO, and with that we moved into the commercial banking operations. So actually as a commercial bank we are only 15 or 16 years, but as a development bank I think we are 41 years. But I think the one strong credit underwriting skills that have been developed have actually helped the bank to move into the SME sector and also the corporate and retail sector. So this is basically about the operating environment that we worked with in 2020. Of course, as all of you are aware, 2020 is one of the most challenging year for any institution. And Sri Lanka as a country also took a lot of measures to ensure that the COVID pandemic is managed quite well through lockdowns and all. And also with the new political change that happened in 2019, late 19, 2020 was the first year under the new political regime where a lot of monetary policies were changed to ensure that there's more conducive business growth opportunities. So as a result, the policy rates were reduced by almost 250 basis points. Then the statutory reserve requirement also reduced by about 300 basis points. And also the bank rates by about 650 basis points. These are all to stimulate the economy that was basically happened in early part of 2020. Apart from that, of course, the COVID outbreak, the first wave impacted the country. So the entire country went for a lockdown for almost 2 months. And then again, when we were operating quite well, again in October, we had to face the second lockdown, but it was a partial lockdown. But with all that, we ensured that the customer service, the business growth were maintained. And I think thanks to all the support from the staff and also the regulators, I think we managed to do well despite all these challenges. Country had a negative growth rate of 3.9% as per central bank data. Of course, with a negative growth rate, and this year, economy is expected to rebound. We see things moving up. I mean, as a bank, we are quite familiar with the growth areas that are coming up. We are seeing a lot of customers again starting their operations. And it's good to see that growth coming in. Central Bank, of course, have indicated a 5% growth rate for 2021. And we see some of the limited tourism coming in and all, some operations happening, especially on the export side, the worker remittance side, there are improvements that we see. Inflation has been maintained around 4 to 6%, and so is the policy rate. Policy rates also kept stable. Exchange rate have been bit of under pressure, but despite all the measures taken in terms of controlling the imports, exchange rate have been depreciated by about 8 rupees during 2021 so far for the last 1.5 months. Now it's ranging around 194, 195 range. And also the trade deficit is expected to be narrowed considerably in 2020. With the rebound in the worker remittances, we expect the trade deficit to be around 5.8% growth in 2020. So these are some other operating environment that we faced within last year. And with that operating performance, I think NDB performance was quite satisfactory. We had total asset growth of 18%. Reaching up to 627 billion from 530 billion, almost 100 billion growth in 2020, a challenging year. I think that is remarkable. Gross loans had an 8% growth, that is 444 billion as of December 2020. And the deposits also had quite a substantial growth of 21% to cross 490 billion. So that alone, again, about 85 billion growth in deposits. In terms of operating income, we were up by about 7%. Total operating expenses were basically kept static at 9.4. That also thanks to a lot of cost management initiatives and also the efficiency improvement program. And operating profit before tax, though it was down by about 8%, mainly due to the debt moratorium, the interest concessions and all that were offered. Profit after tax was about 8% growth from last year to cross 5.5 billion. We also managed to keep the net interest margin about 3%, despite the rates coming down. So now we clocked 3.1%. It actually has come down from 3.5% last year. ROE, one of the best in the industry, 13.1%. ROA, 1.6%. Non-performing loans ratio is about 5.35, slightly up from 4.78 last year. And more importantly, the cost-income ratio, I think that has recorded one of the best in the industry. It has improved to 37% from 40% last year. If not for the interest moratoriums and the first day impact and all, this cost income ratio would have improved to 35.5%. This is again NDB's financial performance, the income statement. You would see interest income almost static from last year, 53.1 billion to 53 billion, slight drop, mainly due to one is the interest rate reduction. Despite our asset book growing by about 8%, the overall interest rate reduction has contributed to almost static interest rate. Apart from that, the interest moratoriums given, the concessions given also have impacted. And also some other COVID-19 loans granted under central bank refinance scheme have been booked at 4%, which is a low rate. So that also have contributed to the low interest income, but still it's a static level compared to last year. Interest expenses, again, slight drop, reflecting the overall reduction in interest rates. You would see from the graph below how the AWPLR has moved from first half 2019, high of 11.45. This is soon after the Easter attack, from that level to 5.74. So almost 50% drop in AWPLR. And then on the 1-year treasury bill rate, again, it has dropped from 8.7 to 5.05. So the rates are coming down naturally. However, the last, the pink graph is basically the net interest margin. We have been managing it around 3.3 to 3.1%. So despite these rate movement, due to strong balance sheet management, active ALCO activities, we have been keeping the rates, keeping our margins at a strong level of 3.1%. This is on the non-fund based income. And this is an area that we have been focusing hard. In a low interest regime, naturally the non-fund income is going to play a key role in a bank's overall profitability. So that's where we see a remarkable improvement. The total non-fund income has grown from 5.9 billion to 7.6 billion. So this is 29% growth, about 1.7 billion in terms of the quantum. This is a sizable one. There again, the breakup is given. The net fee and commission, 9% growth from 3.9 to 4.2 billion, and the non-fund based income from 2 billion to 3.4. So this is actually an area that we have been focusing, and as you can see from the graph below on the right-hand corner, the non-fund based income, our composition in 2019 was non-fund was 24% versus funded or the interest income of 76. Now it has improved from 24 to 28%. So 28% of our total income has come from non-funded income. So that is quite a good improvement based on the focus that we have made, where like the digital channels that we've been working, that focus on trade activities, the transaction banking activities, all have helped to get our non-fund income. And also we had quite a good growth in our card base, and also the personal retail products all have certain fee-based income, all have contributed to getting fee-based income up. And this is despite during the moratorium period, there were certain restrictions on the fees, like the check return charges, the card fees and all. Now that almost for 2 to 3 months, we didn't have those fees, but despite that, we managed to have fee income improved from the last year. Now this is in terms of the impairments. Now again, quite a significant impairment charge as well. 63% increase in impairments from overall 4.1 billion impairment charge to 6.8 billion impairment charge for 2020. Now this is Again, the breakup, both individual and collective level, the impairments have grown up from individual impairment from 2.7 billion to 3.8, almost 1 billion, 1.1 billion growth there, and collective from 1.1 to 2.3. Now here again, you would see the NPL ratio going up from 4.7 to 5.3. So that is one reason. Apart from that, we were very, very critical about looking at our portfolio. Those under moratorium, we critically looked at them. I think one good observation that I want to share is that at the initial lockdown, soon after the April lockdown in 2020, those who applied for moratorium, that time the portfolio was about 40% of our total portfolio that was under moratorium. However, when it came to the second, after the economy opened up, and when it came to the second lockdown in October, by that time, this 40% had come down to 30%. And as of now, this is around 25%. So as of now, about 25% of the book is under moratorium. But there again, we don't have a significant exposure to tourism sector. It is less than 4%. So we are quite comfortable. Most of the clients can come out from this moratorium once these are lifted by most likely April, and they should be able to service the debt. So we are quite comfortable, but we have looked at those, the ability, the individual, their level of activities in coming up with this impairment. So that is why overall impairments have gone up from 4.1 billion to 6.7 billion. Income statement, again, this is about the operating expenses. There we have a very good story. We were in a challenging year like 2020, we have been focusing very much. I mean, these are actually the areas that we are focusing since 2019 in getting our operational efficiencies up. There was a operational efficiency management drive led by the COO to ensure that the group level and our bank level, the operating costs are critically challenged and controllable costs are managed. Apart from that, we also improve the efficiencies through robotic process automation. We are, I think, probably the only bank having several RPAs deployed to manage some of the monotonous activities, and as a result we managed to cut down on the staff costs and also the accuracy and the efficiencies. And also the process improvement as a program that was led by the MANCO, all that have helped us to improve on the cost management side. So as a result, the cost income ratio has improved significantly. You would see from the graph below on the right hand corner, the cost income ratio, which was around 49-50% 5 years back or 4 years back, has come down now to 37%. Quite a good progress there in managing the cost income. And when you compare this with the industry, again, I think this is one of the industry best ratios. Being a mid-sized bank, naturally a larger bank may have scale advantage, the economies of scales, but as a mid-sized bank, again, having this shows the ability of NDB to be more agile, more efficient, so that this is the strength that I think that in the NDB is having the intrinsic strength to manage and the agility. So in the cost, the personal cost, of course, there's a 4% growth. However, in the other expenses, the controllable other expenses, there's a 300 million reduction in cost. So all that has helped to have a 0.4% reduction in total operating expenses from 9.4 to 9.399. Now this is a slide on taxation and the profitability of the bank. Now there again, you would see overall taxes that has come down from 4.9 billion last year to 3.6. This is mainly due to the tax changes, mainly the nation building tax and also the financial services, the debt repayment levy was abolished. So as a result, the effective tax rate came down significantly from 49% in 2019 to 40% in 2020. If you look at our group level tax rate, it's roughly around 38% group level. So overall, there's an improvement in the effective tax rate. So again, the breakup is there. The VAT remains the same, 1.8 billion. Main reduction is the debt repayment levy. Last year, we paid 1 billion. So that is a big saving. And also the NBT, the VAT on that, which is nation building tax, which is 231 million. So as a result, the profit attributable to the shareholders, we had 7% growth from 4.7 billion to 5.1 billion. Profit after tax, 8% growth from 5.1 to 5.5 billion. Moving on to the balance sheet. Despite all the challenges, the balance sheet has grown overall by 18%, or in other words, 97 billion to 627 billion. You would see the gross loans, we had 8% growth. In terms of quantum, it's about 34 billion. Of course, one is the opportunities to lend were also low in a COVID kind of a situation. So it's a matter of managing the portfolio. But there were later in the second half of the year, there were opportunities created in terms of the exporter financing and through our Jayagamu Sri Lanka project, where we were encouraging the exporters and innovators to move up their ladder. Apart from that, even the COVID renaissance loans and all, this all contributed. And also the first quarter of the last year, we were quite aggressive in managing our retail book. So that all helped to have 34 billion growth in our loan book. Investments, of course, have gone up from 95 to 159 billion. That's about 63 billion growth. In the lower opportunities to grow the balance sheet in terms of lending, the deposits that we receive, we have deployed them in some of the other investments. And then in terms of deposits, there's a good story. 85 billion, one of the highest deposit growth, quantum growth that we have recorded, 85 billion. Now there again, I think one good point is out of this 85 billion, 52% have come as CASA. There's 42 billion in this. 42 billion in this 85 have come as CASA. So that is quite a remarkable story. So overall, our CASA ratio improved to 25%. So now this is the fact that I was earlier elaborating. As a young commercial bank, only 15 years as a commercial banking operation, 113 branches. So all these branches, more than 100 branches are less than 10 years in operation. More than 50 branches, less than 5 years in operation. So this is the story where there's enough opportunities for us to go on the grow on the CASA base, especially on the retail side. We have seen quite a good growth coming from the branch network. These are granular CASA that has improved, which is a good story, and that would help us to improve our overall cost of funds and the NIM moving forward. Total equity has improved from 39 billion to 45. This is mainly the retained profits. So as a result, the balance sheet is quite stable, and also it shows the resilient in a difficult year. Loan book growth was quite solid. Other thing is the currency composition of the loan book. This is the area that we were looking at for the last 3 years. So local currency to foreign currency mix, it has improved from 80-20 in 2019 to 83-17. So basically the foreign currency loan book is about 17%. So that's an improvement that we were working on as well. And these are basically the highlights. And on the liability side, as I mentioned, the deposit growth was 21%. CASA growth was significant. Apart from that, in Tier 2, we raised 6.5 billion via debentures, basically replacing some of the high-cost debentures that we were having. So that also has helped us to reduce the overall interest cost. And also, we have announced a rights issue to raise Tier 1 capital by further 8 billion. This was announced in October. So we are working towards that and the rights issue side. So this is a story that I would like to share with all the investors, how over the 4 years, how our balance sheet has basically performed. I think one of the key item here is the customer deposit side. We had 25% cumulative average growth rate. Consecutively, we maintain a 25% growth, and I think this is the best a bank has maintained over the last 4 years. Similarly, the gross loans and receivables, again, 17% CAGR, and total assets, 17% CAGR. So this is why that bank has performed well, and now as our T20 or the Transformation 2020 strategy, we wanted to be one of the top 5 locally listed bank. Actually, we are ahead of that. Before even 2020, we crossed, and we are now the 4th largest listed commercial bank in the country. This is a slide on the capital and liquidity level. Common Tier 1 equity level, the capital level is 9.17%, the minimum is 6.5. Tier 1 capital ratio, minimum is 8, we are at 9.17. And total capital ratio, minimum is 12%, we are at 14.3%. In terms of liquidity coverage, quite liquid with advanced deposit ratio of less than, almost 90%. So the liquidity ratios are quite stable, and net stable funding ratio also, while the minimum is 90, we are at 112%. So these are quite good capital and liquidity position, but of course, in terms of capital raising activities, that we are trying to work on our Tier 1 level because of the high growth plans that we have. So we have already announced the rights issue so that the capital can be raised by 8 billion. This is with 28 new shares for voting shares for every 61 shares at 75 rupees. So this will help us to further strengthen the balance sheet and also help us to fund our balance sheet growth because the bank is in a very aggressive growth arrangement. So I think the capital raising would help us to have better ratios to support the growth. Thought of sharing with you some of the COVID related responses that NDB did. I think we are one of the first to react to the COVID threat, the lockdown. We are the first to even deploy the mobile ATMs among all banks countrywide. We also had a very streamlined operation, sharing that through WhatsApp messages where we are coming. Then the digital financial services, our NEOS app and all, took quite a big move towards going to the customers through the digital channels. And then we saw quite a significant usage of digital channels. And also the activities now about 80% of our transactions, all bank transactions are now driven through digital channels. We saw about 400% increase in volume of transactions and 500% increase in value of transactions during the lockdown, and that remains same. So the NEOS app has performed very well, and that is also basically touching the customer requirements. And then we have been constantly updating all the features. One of the first to enter into the QR code, one of the first to have all wallet and digital app all in one. So a lot of features included, so that actually has helped in a lockdown kind of a situation for our customers and even non-customers to transact. We have several non-NDB customers also using the NEOS app. And also branch bank to you proposition also helped to reach out to the customers who are unable to come out, and that has helped also to raise a lot of CASA deposits. Now, despite all the other challenges, bank continue with our other programs. Apart from the cost drive, we have also came up with the Saubhagya loan scheme or the Renaissance loan scheme, promoting the exporters and also the innovators. These basically were conceptualized during the first lockdown, and soon after the lockdown in August, we launched this. There we tied up with several entities, including DARA's Code 365, to have a export and local vendor platform for our customers, and also the Chamber of Commerce, the Export Development Board, to come up with various incentives, and also the shipping lines like MERS to come up with a lot of incentives for the exporters to encourage them to export. We also worked on assisting the banking on women proposition, and we tied up with the MTV network to promote the Vanita Bimana award scheme for the women, and also to support the micro SMEs. In terms of other CSR activities, I think we didn't stop. I think we worked on various CSR projects. I think that shows the dynamism of the NDB staff. Whilst we are growing the book, whilst we are ensuring the staff safety, also ensure that we have one of the best staff safety arrangement. We did a command center during the COVID time to ensure that the staff health, their safety is protected. We also provided transport to all those staff. About 6 routes are being used for provide transport, which is still being continued to ensure the staff safety. With all that, we also worked on the other CSR activities. So that is overall, not only the financials, but also on the other hygiene sides, we have been working very hard. So I think that's why it's overall quite a good progress that NDB made. We also worked on our strategy. So just to share with you the way forward, now the financial year is over. We came up with a transformation 2020 strategy in 2017 to become one of the top 5 banks with asset base of over 500, but we crossed 600 billion. With that, with the political stability, we worked on a 5-year strategy. And that's where we worked on the strategy in the latter part of 2020. And we shared that with our staff internally, which we have dubbed it as Voyage 2025. It's a 5-year strategy, knowing that the political stability and the policy clarity will be there for the next 5 years. And our midterm, our strategic focus is to make the banking group, the NDB banking group, the banking group of choice for our customers. So in that, the customer centricity would be a core pillar, looking at customer requirements, looking at their gaps and how we can fill those gaps through various banking services. It's not only selling or providing the bank's usual off-the-shelf products, but through transaction banking, trade activities, so many that have been lined up in our strategic plan to provide customer-centric solution. Another core pillar is the digital drive, where we have invested in the best digital platforms. We are going for a core banking upgrade that would be available from the second half of this year. But in that, we are the only bank who has invested in a digital layer to provide more digital-based solutions. So these are a little bit of highlights from our 5-year strategy, which has already been launched, and we are working quite closely with our staff to ensure that NDB is made the banking group of choice. So with that, the prepared presentation is over. So I leave it to you all to raise questions. Of course, you can raise this through the chat option in the MS Teams window. So please post your questions, and we are happy, along with my team, to take up those questions. Okay, there is a question. When you say growth in fee income and digital banking, could you elaborate as to what exact new revenue streams have developed and whether there is a growth in existing revenue streams? Also, would it be common among the others in the industry? So basically, new revenue streams, I don't want to elaborate more. However, all the business lines have contributed in terms of getting the digital banking income side growing. So we have quite a close-knit arrangement. The digital bank is working very closely with the retail banking, SME and corporate to ensure using our NEOS app and the digital channels, these solutions are offered to the customer. So as a result, it's a very cohesive kind of arrangement where digital, we have not given digital banking a digital target. Actually, digital income streams are targets of all the other business lines as well. So team very closely work to ensure that we get the best out of that. Apart from that, naturally, the trade and the transactional banking income also have helped us to improve on the non-fund income. There's a question as for reducing cost-income ratio, exactly what costs have been slashed and could it be sustainable? Of course, we are not slashed any costs. We have managed the cost and it is sustainable. And even the January, February numbers also shows that the cost management is sustainable. Deepal, you want to elaborate a little bit?
Yes. Yeah, yes, that's the key thing what we did. We want to make sure any cost reduction we do is a sustainable one. And when we are doing it, what we did was we went through the first, we selected the highest 20 cost items in the bank and very in a more scientific manner, we were addressing that. Mostly we use automation. One example I could say is we reduced about 8 million paper printing from the bank. What we did was without printing, we digitalized those. And that is basically a
simple example.
Simple example. And also, we realize our interbranch, when we get a telephone call, there was a charge within the interbranch as well. Those were the ones we deep dive and analysis. So what we did was we used the digital technology and calls are basically taken via the IP phones. So when you do like that, there won't be a cost if you take a call from a single branch to within the bank and another branch. So you could see all items. I think just like this, we had about 60 items. All the items are like that, sustainable, long term, and we didn't get people to use more, work more. All these items are using automation and re-engineering, and mainly using the advanced IT basically in the world.
Okay. So I think in short, as Deepal explained, these cost managements are all sustainable. That is the key message here. There's a question on, there is a 677 million individual impairment write-off in fourth quarter. Can you please elaborate? I think this is mainly the retail side. As a policy, we do have an internal policy which is in line with some other foreign banks as well. Based on the number of months, we take an internal write-off on some of the retail products. However, that doesn't mean that we won't stop the recovery efforts. These are to ensure that the portfolio is quite looked at in a very critical manner, because these are based on portfolio analysis, the vintage analysis, and also that is where the retail portfolio also certain write-offs are made. However, the recovery action will continue. So that is specifically about the retail portfolio. What's the target CET1 for 2021? I think with the capital coming in, we are looking at around 10% Tier 1 ratio. Apart from the rights issue proceeds, capitalization of some other profits also would help us to get about 10% CET. What is the expected loan growth for 2021 and the growth in which products? Of course, with the capital coming in, we have some high plans for the loan growth. And it would be in line with the central bank expectation. It would be a double-digit figure. Specifically, the coming in from, I would say, both corporate and SME and retail, all three plus the project finance. So I think all four areas have contributed to the loan growth in last year as well. And we want to ensure that this portfolio mix is maintained rather than concentrating on one sector. We have quite a good pipeline. We have been very active in the project finance space, and that's where with the country's some of the economic growth aspirations being discussed on the construction sector, the road development sector, power generation sector. There are a lot of opportunities. For that matter, NDB in the last 3 years have been funding 30% of Sri Lanka's renewable energy power generations. NDB has involved in those activities through our project finance. So that's an area where we see opportunities. Apart from that, the retail had quite a good growth last year. So we want to continue the same space. We are the only bank with quite a significant sales force who are very professional and doing a great job. So we want to continue that same trend. So is our corporate banking, one of the best corporate activities that we have, one of the best good set of clients. And there again, in the new strategy, we are working on different concepts to get the best out of these relationships. It's not only the growing the balance sheet, but it's what sort of wallet share we get from these clients, what sort of overall income that we get, what sort of customer-centric solution that we provide. So all that would get covered. And so is the business bank and SME side. Again, taking quite a big progress there now with our ADB refinancing arrangements, solar refinancing arrangement. We have been very active, and we are one of those banks in the forefront. So that's where all the growth they expected from key business, 4 business lines. How much of tax saving you do expect in 2021 given the lower tax rates applying to the bank? Swendra, you want to comment?
So, as you know, lower tax savings would come from the income tax rate if it's legalized, enacted by the Parliament, which is the 24% that has been proposed. So, approximately we expect around 400 million saving for all for the bank in terms of income tax. So that will be applicable for all banks as well. This is apart from any tax saving or tax efficiency practices that the bank will apply in the normal course of business.
That's another question. Can you have an approximate breakup of your book under moratorium? So as I mentioned, as of now, about 25% of our total loan book is under moratorium. Most of them are due to basically finish by April. And I think bulk of them are between corporate and SME. Of course, we have individually looked at all those accounts. Most of them have ability to basically repay. Some have basically taken the advantage of the moratorium, but they have the ability. But I think most of them have the ability to repay come April when the moratorium is lifted, except for those in the tourism sector. Most likely the moratorium for the tourism sector might get extended given the travel restrictions. So there again, as I mentioned earlier, the tourism sector exposure is less than 4% for the bank overall book. So we are quite comfortable that we should be able to manage after the moratorium is over. There's a question, bank has taken the highest impairment provision that's reported in a quarter when the NPLs have improved around 20 basis points. Is this due to the anticipation of moratorium extension maturing in first quarter? Can you explain a bit more regarding the impairment taken in this quarter? Swendra, you want to update on that?
So actually, as of December, given the second wave impact, which had an effect on the fourth quarter. And since these impairment provisions are based on expected losses that may come in the future, bank applied an appropriate economic factor adjustments in the application of collective modules. So with that, since we saw a certain deterioration in the economic factors or the macroeconomic factors during the fourth quarter, as well as the expectation that we took, we took a moderate view on the expected ratios, particularly GDP growth and certain other interest rates and the inflationary factors. So with that, management has created certain overlays to handle any expected losses. So actually these may not realize in the future. However, given that globally also, apart from the normal impact, we have to factor in certain impact for COVID. So therefore, management has taken a view on that and taken a management overlay.
Okay. Again, there's a question of the new growth. What share would be retail versus SME, and what sort of products to retail? I think we have been targeting now our retail and SME roughly around 45% of the book is retail and SME. Balance 55% is corporate and project finance. So I think our long-term target is to get these to around 50%, both retail and corporate, to improve, and then the project retail and SME to improve to 50%. So in that growth, as I mentioned, I think both will equally have growth coming for this year as well. What sort of products to retail? Sanjay, you want to comment?
Yeah, basically, we are looking at housing, personal loans, and also we are concentrating on the pensioners' loans. So those are the most important products, and in addition, in a small way, pawning and leasing, and also leasing. So leasing is a big product for us, and so those are the main products that we will concentrate on.
There's a question on non-fund-based income growth was mainly on the back of gains made out of sale of government securities. How long bank can continue to make gains from government securities? So Niran, would you like to take that question? Niran is our head of treasury.
Probably it looks like the interest rates have already come down significantly, and looks like it's bottoming out. So we do not expect the same amount of capital gains to be realized from our portfolios for this year and next year. However, we generally try to balance it out with our net interest income and the capital gains together. So both we strategically manage. But obviously, unlike something similar number may not be able to write what we made in 2020.
With the moratorium extension coming down to 28% from initial 40, how have been the collections from those moratoriums which did not extend, 12% which did not extend? Actually, the collection have been good. And there was no need for them to remain under the moratorium, so they voluntarily have started paying. So I think collection story is good. That 28% has further improved to 25%. Could you talk about the provision coverage ratio at end of December 27? Do you want to comment?
So the impairment provision coverage has improved from 3.1% to 4% as of 31st December.
So 3.1% in 2019.
2019.
So almost 25% improvement, right? What has happened to the bank's ISB and SLDB holdings? And how is NDB impairing for these securities?
Currently 20%, but we have received a direction effective 2021 that we can impair it at 10%.
Yeah. So the ISB and SLDB holdings remain same,
Remains.
right?
Yes,
And
yes.
our maturities are beyond this year, 2022 and beyond. And the returns are quite good. As Niran said, the impairments, the central bank has given a direction from 20% to bring it down to 10, which would be effective from first year, so from this year. So actually the 2020 December numbers won't reflect that. Because we have built in sufficient provision based on the 20% risk-weighted assets. However, this is expected to come down to 10%. There will be some provision releases that is expected when the quarter numbers are released for this year. On the top of the rights issue, looking to increase capital adequacy ratio, a cash dividend has been declared. Any comment on this? It looks like whoever asked that question would like to have a dividend. It's an interim dividend that we declared ₹1.50. But of course, there will be a final dividends later on that bank. It's up to the bank's board as well to decide. But this is an interim dividend that we have declared. There's a question, which industries is NDB's loan book most exposed to? I think we don't have any concentration risks at any particular industry. I think the portfolio also quite mixed. Project finance, corporate. Corporate is mainly on the working capital, trading, the export finance. Retail is again quite a well spread set of clients. Our Dreammaker loan, that's the largest portfolio in the country. Very good NPL ratio. I think more than 50% of them are professionals. So I think it's a well spread sector. So I don't think we have any concentration risks as such in any particular industry. Do you expect the rate caps on non-fee based products to come off this year? That is our expectation, but it's up to the regulator also to manage. We are looking forward to some changes there. But I think on the other hand, customers are also having difficulties, especially in a COVID kind of a situation. So we need to take a balanced view here rather than only going on. I think that's the right decision at that time taken. So probably when the economy eases off, the regulator also would look at relaxing some of those fees. Now even the card rates have been kept at 18%. Some of the fees have been kept. But on the other side, the cost of funds also have come down. So I think that's something a regulator also have to take a call on that. How is the demand for 7% housing loans? What are your margins on this? Sanjay, you want to comment?
Yeah, actually, there are few inquiries and few have obtained their loans at 7%. In terms of the margins, of course, we don't have a margin on that. Banks have raised their concerns because gaining long-term funding, the cost still remains quite high. So it's more sort of we are complying with the regulators. So that's what it is.
Of course, the salary, it is only limited for the salaried employees. And I think one of the requirements is salary to be assigned to the bank. So that's one way of managing the overall costs. But as Sanjay said, it's a challenging proposition, especially giving fixed rates for 5 years. However, we are managing that at the moment. Any reason that a stage 1 impairment has substantially increased with the minimum growth in the loan book for the quarter? Swindini, can you comment on that?
So stage 1 impairment is mainly made on collective basis. So we apply collective models. So as I explained, we took a conservative view and applied economic factors that are justifiable economic factors. So with that, we have created these management overlays, particularly in the stage 1.
Thanks. That's a question probably Niran can answer part of this. Banks are told to sell 10% of the remittances that converted each day by central bank, and is this already happening? Then the ₹2 extra paying by the government for the worker remittances, how is it? How the process is happening? The bank gives that extra ₹2 to the customer and then recover it from the government, or has the government been paying? So actually, the 10% of remittances, that is
both are happening currently. The first one is how we have to collect a minimum of $10 million. Then we have to pay 10% out of it. So the minimum lot which we send to central bank is $1 million. So whenever we reach that threshold, we need to sell it at the volume weighted average rate to central bank. Then the number 2 on the ₹2 extra payment also is currently happening, and we need to submit that, and all these details are provided to central bank. And for the time being, we are accruing it, and we expect the payment to be made because central bank has given that and that they will recover and they will pay us.
I think those, whatever the commitments given, central bank has been honoring. And for example, the Saubhagya loan scheme, I think we were the 4th largest in terms of granting. I think we granted about 18 billion. And refinance, I think almost all those refinance that has been committed by the central bank, we have received it. In terms of current deposit mix, including the 21% increase for deposit book, what percentage is coming from retail depositors? The retail is quite a substantial, Sanjay, what?
70%.
Yeah.
Roughly about 70% of the deposit book is coming from retail, thanks to the branch network. So that also shows about the granular nature of the deposits, which is just solid base. In 4th quarter, what was the shift in your loan book from stage 1 to stage 2, from stage 2 to stage 3? So when you would like to comment on that? So while Surendran is going through the numbers, let me take the other question, which is in the worst case scenario of a sovereign debt default or agreeing to stringent condition to avoid one, what could be the impact on NDB and how prepared is the bank? Iran, you want to comment on that?
We doubt that
worst case.
We will get to that position, but only thing is that what we can found is that definitely, even if that happens, there will be a most probably postponement of the payment. And from the bank side, we do not have that much of borrowing to fund this. It's mainly funded through our deposit base. So we don't see a significant impact of that portfolio, holding that portfolio, as long as that we can roll over our deposits books and some of our multinational agency borrowings, which are very, very strong, and they still have the appetite for NDB. So as long as those works out, then we don't see a huge significant impact on the bank balance sheet and the P&L.
Yeah. And also, I think very unlikely that this situation would arise. The reserves, I mean, the first debt payment is coming 1 billion in mid this year. I think the reserves are sufficient, and then the swap arrangement that the government has negotiated would also help. So very unlikely this kind of a scenario happens. So Niran's answer is, in case that extreme situation happens, again, our funding, we don't have that much of borrowing that are maturing. And also, I think I shared a slide where our balance sheet mix foreign currency to local currency, that also have improved in favor of local currency to 83%. So that is actually, but again, that 17% dollar loan book is also funded by our own deposits. Most of that is funded by our own dollar deposits.
ADR to foreign currency is 72.
Okay, so our ADR in foreign currency is about 72%. So that shows that the dollar deposits are adequately funding the dollar lending book. So I think that way the impact would be minimal. Yes, Swindlini can answer the question.
Yeah. In terms of the shift in the staging portfolio, as of the fourth quarter, out of the total gross portfolio, stage 1 comprises of 79.5%. Stage 2 comprises of 12.2% and stage 3 at 8.3%. And if you compare it with the third quarter, we see a marginal improvement in the staging over the third quarter, particularly in stage 3.
Okay, thanks. We would also like to highlight all these numbers were audited by Ernst & Young, and I think these were subject to quarterly audit as well, because we have been capitalizing because of certain capital constraint quarterly audits. So all the impairments, the staging numbers, all have been vetted externally also by EY. Any confirmation regarding the rights issue date? Yeah, so that would be announced very soon. We are working on that. So I'm unable to share more details on that, but it would be disclosed quite soon about the dates, so that we can complete the rights issue in a faster manner. These are the questions that we have received so far. If there are any other questions? So in the absence of any other question, we would like to thank the investor community for taking part. It's quite an active participation as usual. So thank you very much. I think we are quite happy to share these details with the investor community. This is part of our open investor briefing activities that we have been conducting, as I mentioned, every quarter. And thank you for all the support. And we'd like to meet up with you all personally once the COVID lockdown restrictions are relaxed. We would like to personally meet as well. I think hopefully with the rights issue announcement and all, we should be able to have some kind of a arrangement meeting with the investor community. Whilst thanking all of you, looking forward to meeting you all again through a webinar like this, and would like to thank my team also for the answers and the support given. Thank you very much.